Welcome back. Today we're talking about a renovation loan versus a HELOC. Although I'm going to go a little deeper than that. We're going to go through renovation loan versus a HELOC versus second mortgage versus like a personal loan slash official renovation loan that doesn't have a lien on your property. So let's dive in. I'm Stephanie. I've been a loan officer for over 18 years, and I have created this channel because I really think the mortgage industry is lacking accurate information and knowledge, and I think applied knowledge is power, and I want you all to have a basic understanding of what you're looking for up against and your options, and I think that it would be really, really helpful. So thanks again for tuning in. All right, so let's say that you have, because where the market is right now is it's a seller's market, yes, not a buyer's market, and so what that does is some people as sellers, they might go, well, you know what? I might not want to move up because of all that's going on. Maybe I'll just go ahead and add on to my house, or maybe I'll just go ahead and upgrade the things I want to upgrade, or do the cosmetic changes that I want to do cosmetically and stay where I am. So when it comes, or let's say maybe you are looking to purchase a place and there's less on the market to choose from, and so maybe you want to find a house that you don't mind renovating, and what might things like that look like? So I think that I can help you in all of those realms today with this topic. So let's say with a renovation loan, like we have some renovation loans that are fixed rate mortgage renovation loans. So I'm not talking construction or renovation that's not a fixed rate. I'm not talking construction or renovation that's a temporary loan. I'm talking about like an actual backed mortgage with your rate fixed from the day that you close, which can be different than those other products that I'm talking about. When it comes to that, sometimes we can do between a 95 and a 97% loan to value on a purchase or a refinance. Let's compare. Now, if I go to the bank and I'm trying to get a typical renovation loan, most of the time, and there are always exceptions, but most of the time, they're gonna want 20% down, and if you can get away with 10, you're gonna be super, super lucky. And that's on a purchase or a refinance. Well, here, if we can do 95 to 97% loan to value, that's a huge difference and a drastically amount of less money out of your pocket. Now, let's say that you own your home and you're debating on, do I do a renovation? Do I do a HELOC? Do I do a second mortgage? Or maybe it's simple and I just want to get windows, but I have a lot of windows and maybe those windows are $20,000. What do those things look like? So when it comes to the home equity line of credit, of course, I've got some other videos on that. Please be sure to check them out on home equity line of credit, and even some that are comparing HELOCs to second mortgages. But on a HELOC, many banks limit the loan to value to 80%. Some will go up to 90%. When it comes to a second mortgage, many banks will limit to 80%, some will go to 90%. And when it comes to just like a renovation type of loan, or you're buying like the new roof or the solar panels or the windows, sometimes those companies, or putting in the pool, sometimes those companies will actually offer you their financing, which is more of a personal type of financing and not putting a lien on the property. Those are going to be the highest of the interest rates. Now, interest rates are all over the place right now, and they are changing constantly. If I'm looking at this list, the personal loan, I have seen, and I did a little research for this video, I have seen interest rates anywhere between 8% and 25%. On the second mortgages, I was able to look up, because I'm not quoting these rates to you, I'm just giving you information based on research that I did. They were in the 8s on the fixed rate second, while the HELOCs were more closer to the 6s. Remember, the HELOC is an adjustable rate mortgage, it's not fixed, whereas if these other two I reference are ideally fixed, and where the renovation loan is more according with the typical mortgage rates, which a number of factors goes into your rate for this, like so many factors. And so I'm not quoting an interest rate when I say that in the recent research, and according to Freddie Mac as an example, those rates are running in the 5s. So when it comes to the renovation, it looks like at the current time, in the current market, you're gonna get the lowest interest rate on the refinance, the renovation refinance. You're gonna get the highest loan to value on the renovation refinance, which means you're gonna have the least amount of money out of pocket on the renovation refinance. So let's see kind of how some of those numbers might break down. Now, what's important to know about the renovation refinance, let's talk about that for a second. Let's say that you have a house with a $200,000 loan for 30 years. Let's assume you got this loan in the last year when the rates were super low. So $200,000 loan, 30 years, let's say you're at 3.25, and you decided to renovate. And for that renovation, you're gonna need another $100,000. You wanna do a 30-year loan again, assuming that the value is what it needs to be so you can borrow the full 100 on top of the two. The 200 and 100 would be consolidated into one. See, I hate to say the old days, but in the past, to do something like this, you would need a cash out refinance, which would limit you most recently to 80%. In the past, it was more, but to 80% loan to value, and you're paying a much higher interest rate because you're taking cash out. This is a wonderful way to avoid a cash out and go over 80% if you need to and still get a good going interest rate. So let's say that the $200,000 for 30 years at 3.25, that gave you a payment of $870.41. But now let's say that you're having to do a new loan at 5.75%, and you've got to incorporate that $200,000 as well. So now we have a $300,000 loan, 30-year term, 5.75% interest. That payment is an enormous jump of $1,750.72. So let's take these same numbers and compare to some of the other options, all right? Let's say that we leave your $200,000 alone at 3.25, and we go with a personal loan. And let's say 11% interest. Those rates I researched were between 8 and 25%, but let's just use 11%. Now remember that 11% is only gonna be on our 100,000, okay? So 100,000. Oh, and those personal loans, they're not gonna do it over 30 years though. Maybe 60 months is probably a good guess. I don't do personal loans, so I don't know a ton of information about them, but with what I was researching, you're not gonna get a 10, 15, or 20-year renovation loan. For the purpose of these numbers, I'll go ahead and do a 60-month and 120-month, just in case, so you have the information, although I don't believe that you can go out to the 120 or the 10 years. But so now we're gonna take $100,000, and we're gonna do 5 years, and it's gonna be 11% interest. What's that payment? $2174.24. And if we did that for 10 years, that payment's gonna be $1377.50. All right, so in scenario 1, we're gonna add our $2174.24 plus our $870.41. So that gives me a total of $3,044.65 compared to $1,750. Now we're comparing that to $1,750, and it's a lot more, but keep in mind your $1,750 is over 30 years, and this higher number, the $870 is over the 30, but the $2174 is done in 60 months. Let's compare the interest paid just for fun. All right, so if we did a $100,000 loan, $100,000 loan, 5.75 interest, 30-year term. You're gonna pay back $210,086 on your $100,000 over 30 years. Remember, that's only if you keep the house for 30 years. If you move in 5, this does not apply. Now let's take that same $100,000 and let's do it for 5 years at 11% interest. Then you're only going to pay back $130,454. Super surprising, right? Now, if you can afford that, maybe that's an option for you. You're not paying back quite as much. Even though it's a much higher interest rate, it's a much, much shorter term. Now let's look at the 10-year option. All right, so we've got $100,000. We've got, let's say they gave you 8% interest, 10 years. Well, let's stick with the 11 because that's what I did earlier actually. So 11% interest, 10-year term, $100,000. You pay back $165,300. So even though that interest rate is so much higher at that 11% versus the 5.75, because it's on such a shorter term, you're only going to pay back $165,000 compared to the $210 if you did that at the higher amount. And that doesn't even take into consideration the first option of the renovation refinance, where we're taking that additional $200 from 3.2 up to 5.7. So those numbers would be even worse in that example. And I'm showing you all of this because I want you to realize that, how do I say this? It's not that nothing is as it seems, but you should never make any assumptions, right? Because until you actually sit down and calculate accurate numbers based on your specific scenario, you cannot be sure what's right, wrong, or what's good or bad, or what's better or worse. Because looking at this, I bet all of you are probably surprised at these numbers. Now, again, keep in mind that we're comparing these over 30 years versus over 5 and 10 years. So you really need to take that into consideration when you're also looking at how long you're going to be in that house and how long you're actually going to repay the loan, because all of those things will make the difference as well. Now let's take our same $100,000 on a HELOC. The negative thing about the HELOC, or it can be negative, is it's interest-only payments based on what you've drawn, and it's an adjustable rate mortgage tied to the prime rate of money, and it's only likely to go up based on the future predictions. So with that being said, unless you're in a position to where you can pay off that HELOC super fast, it's probably not going to be the best option. I mean, if it's at a 6% interest rate, then that payment's only like $500 a month compared to all these other payments that we went through, right? But you're only paying interest. You're not paying off that principal, so you really want to keep that in mind. Now let's compare to the second mortgage, which if I'm comparing the second mortgage to the personal loan, if the personal loan has similar terms and similar interest rates, but there's no lien on my house, well, that might weigh heavily, right? But if the second mortgage is 8% and the personal loan is 15, well, I mean, that's something you want to take into consideration as well. But on the second mortgage, those are usually over 10 or 15-year terms, okay? Remember that renovation loan can be over 30. The personal loan is probably over 5, over 10 if you're lucky. The HELOC is interest only. You'll probably have to pay it off in 5 years. There might be a balloon or a readjustment. And then this second mortgage is between 10 or 15 years most of the time. So let's take our $100,000. Let's say if it's 15 years, let's say if it's 8%, that payment's going to be $955.65. And that's paid off in that period of time, and then it leaves your first mortgage in place, just like the HELOC leaves your first mortgage in place at that lower interest rate, and then you've got those two separate payments that you're making. It's a lot of numbers, I know, and I don't want to overwhelm you with the numbers. The whole point is, and I really hope that you're seeing it, is that you need to run your numbers. It's kind of off topic, but a similar example of when people would say, well, I've always been told that if I don't drop 2% on my interest rate, I shouldn't refinance. It's absolutely not true. It depends on what your situation is, your scenario, your long-term and your short-term plans. Now let's go back to this first renovation, where now you're thinking, ooh, maybe that's the worst idea besides a second mortgage or a personal loan or a HELOC. Well, let's say that $200,000 loan plus the $100,000 renovation, now you've got $1,750 in your payment. You're paying back a whole lot of extra interest, okay? But your point is to sell the house within the year. And you know that by putting in that $100,000, that now $300,000 loan that you have, but now your value is actually $500,000. I've seen plenty of things like this happen. And so now what you're going to do is you're going to be flipping the house in the next year because you've got all that value. That's also something you want to take into consideration, because if you're absolutely guaranteed to be selling that house, which is always hard because there's no guarantees in life, then maybe the HELOC might be the option because that gives you the cheapest payment. And you know you're just floating payments until you offload this house in a year. So as you can see, just really depending upon your long-term and short-term goals are really going to depend upon what route is going to be the best for you when it comes to a renovation loan or a HELOC. I hope you've enjoyed this material. Please reach out if I can help in any way, weeksteam.com or 985-300-LOAN, and I look forward to seeing you in the next one.